And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome back to the show this morning. It's Tuesday already. Yesterday, bit of a conundrum yesterday. Couldn't do a show yesterday. Brent had a dental emergency. Sucks getting old, doesn't it? So, anyway, he's back. So we're back. And this is to show you how important his job is. We can't have a show without him here. So, just goes to show you, this is what you call, for you younger people, this is what you call job security. If you want job security, you have a job that nobody can do something at. Well, you can't produce a radio show without him around. So that, when he's 98, still be back there producing the show.
But did you like sleeping in yesterday?
I didn't get to sleep in. I had to get up early because, I couldn't have a nice peaceful weekend. No, Hamas has to go fire missiles into Israel. So now I got this to deal with all day yesterday. Yeah. So yeah. Up early yesterday trying to evaluate the impacts of that on oil prices and bond prices, everything else. Of course, that was the big news over the weekend. And of course, that continues on today. Again, what we're seeing is, and this is, what we've talked about previously, lots of commentary, about interest rates. Interest rates are going up. Bond prices are going down because of the debt. It's a faulty analysis. Right? There's no long-term correlation between bond yields and the amount of debt we have, because if that was the case, interest rates would already be in the 20 percentile range. I'm exaggerating a little bit, but the point would be we've been increasing debt for 20 years, so it was not just the moment that all of a sudden we go, oh wow, we've got debt. Yes, we have debt. But what there is a correlation to, of course, is interest rates, inflation, and economic growth. And this is the context of the article that's on our website this morning. But here's the important, we're going to talk about that some this morning. But what's important here is, as we've said before, is that whenever there is an event of uncertainty, whatever it is, whether it's a financial event, whether it is a market event, or whether it's a geopolitical event like Hamas launching missiles into Israel, right? Terrible thing, right? Terrible thing. But immediately investors go, I need safety because I don't know what's going to happen. And where's the one place they go for safety? U.S. bonds. And of course, yesterday, big reversal in yields, coming down today some more. So this is the biggest reversal in yields that we've seen since the Silicon Valley Bank crisis back in March. Again, whenever there's uncertainty, what's the first thing people look to? They want something that is guaranteed safe. And this is why we call the U.S. Treasury a risk-free investment, because it has a governmental guarantee of repayment. Now, of course, you can make the argument that, well, at some point the government's just not going to pay it off. Well, yeah, we could always make that argument. It just hasn't happened in 180 years, so it's probably not going to happen anytime soon. But again, doesn't mean it can't happen. I'm not saying that, but we have to keep things in perspective of what's realistic versus, kind of fantasies and realities, those type of things. So again, the first place people look for in moments of turmoil. Now this could change in a few days, right? So let's say over the next 3 days, Hamas backs down, Israel, they work everything out, whatever it is, this kind of geopolitical crisis ends. And our focus turns back to inflation. Well, interest rates could tick up a little bit, right? Because there's still concerns about inflation short term. But that's what drives yields, right? Yields are driven by inflation, economic growth, and wages. Now, economic growth is slowing, wages are slowing, inflation is declining. But nothing goes straight down. You're going to have bumps along the way, right? You have little upticks here and there. But the trend of all this data is certainly weaker. And ultimately, that leads to a bigger decline in yields. But again, we're going to talk about that some more this morning because it's an interesting phenomenon that we live in right now. And again, we'll talk a little bit about, contrarian investing and those type of things. But anyway, yesterday, of course, kind of a very interesting day as kind of it goes, considering the news that we had over the weekend coming into yesterday's market kind of action. The way the market started is what you expected. The way it ended, not so much. here's what you need to know before the bell this morning. So again, what is happening overseas certainly has not changed the context or tenor of the overall markets. But yesterday, the markets did open, kind of lower. And as expected, we had a big rally on Friday. And then on Monday, the markets opened lower and immediately kind of started recovering during the day as the markets assessed what the global what the global risk were of the conflict right now between Israel and Gaza. So, as we kind of take a look at this, the markets had a very nice day running into the first level of resistance this morning at the 20-day moving average. Again, very minor level of resistance, so look for a bit more of a push higher. Importantly, though, this is the one thing that we've been talking about here for the last, really 2-3 weeks during this decline, is that as we came down and tested this 200-day moving average, which was kind of key critical support for the markets, we said that the markets had to hold that level of support right there if we were going to get this rally that we were looking for. We did hold that level of support. We did come up and break above this kind of initial resistance level in the markets. And importantly, though, we triggered that MACD buy signal. Now, it's a very early trigger, so we need a couple more days of follow through to make sure that trigger is going to stick, right? So sometimes it can get there and kind of fade back off if the markets don't continue the rally. So if we can get some follow through rally today, and again, futures are pointing higher this morning. Not strongly so. They're up about 40 points on the Dow right now. So again, it's not a real strong open. NASDAQ futures are up about 10, 11. S&P's up a little bit this morning. So not a real strong open this morning. Again, we're going to challenge that 20-day moving average right out of the gate this morning. Can the markets get some follow through? Can we get above that? If we do that, we're going to get to our target of about 4,300, which is going to be the 100-day and the 50-day kind of moving average resistance level there. So again, you've got some decent levels of resistance on this rally. So I, kind of look for people that were trapped in this sell-off. There's a lot of investors kind of trapped in that decline. Look for them to sell as we get closer to these levels of resistance. They're like, oh my gosh, I got my money back. I'm going to get out. So look for some selling pressure to come in. But as long as we can kind of maintain this buy signal and keep the market from getting grossly overbought on a real short-term basis, we do have some ability to work this market higher over the next month or so. And this is because we've got a few things going on. First of all, we're going to kick off earnings on Thursday, really today. We're going to start with Pepsi out today. And then later this week, we're going to have airlines, United Airlines, of course, Delta, et cetera. And then get into the major banks on Friday, JP Morgan, Bank of America, et cetera. Then next week is really going to kind of start earnings season. So we're going to start to shift our focus from international geopolitical intrigue to corporate earnings, which should help lift markets. Again, estimates have come down dramatically. That gives us the ability to have the kind of the millennial earnings season. Everybody gets a trophy, so everybody be happy about the earnings, and then we'll start stock buybacks in November. So there's a lot of shorts out here against the markets right now. So if this market continues to get a little bit of lift to it, it's going to be fueled a bit higher by short covering. These computerized trading algorithms, these CTAs, have a lot of buying to do to cover short positions if this market rally continues. So keep a watch on this. Again, sell signal, the buy signal's in place. Again, we need a little bit more follow through today, so we'll have a little bit of an update on this tomorrow. But again, kind of just manage your risk accordingly for right now, but things are starting to kind of play into the normal seasonality. So that's what you need to know before the bell this morning. When we come back, we will talk about, kind of market psychology, investor psychology, more than anything else. And talk about the overvaluation of stocks relative to bonds. That's coming up right after the break on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
October means it's time for open enrollment into Medicare. How is your health insurance going to work after you leave your job? Our next Lunch and Learn will tackle transitioning to Medicare Thursday, October 12th with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn Thursday, October 12th with Ratliff and Rosso at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So Brent, I think my wife's having an affair on me.
Really?
Yeah. Well, you know, they say there's some surefire signs of when there's infidelity in a relationship, right? So my wife's been working really hard lately, losing weight.
Yeah.
You know, and she looks fantastic.
She does.
Looks fantastic. And she's very cute. So, you know, that's kind of the first sign. And then her phone's been ringing all hours of the day, right? And she just looks at it, she kind of hangs up or she puts it down, right?
Yeah.
Doesn't say anything about it.
Yeah.
So, you know, it's kind of a second clue because they say, you know, one of the other signs of infidelity are, you know, phone calls and, you know, unanswered things like
Yes.
that, right? So very suspicious, very suspicious. So she went to go in the kitchen yesterday and, you know, she wasn't paying attention, left her phone laying down. The phone rang. I looked over.
Yeah.
Yeah. Some number, potential spam, keeps calling all hours of the day. And so I think she's got something going on with somebody named potential spam. I don't know who that is.
Potential spam, not potential spaz.
Exactly. But you know, all seriousness, right? These numbers, you know, I don't know, you know, like I block them all when they come in, right?
Yeah.
It's like, and they just
it's an ongoing process.
Yeah. And I thought there was a whole thing about, you know, like if you told people like, you know, my number's on a do not call list, I'm not supposed to call you. Yeah. I think they have that list that they're all, they're on the do not call it. Let's call those numbers.
Yeah. Yeah.
So,
and you're supposed to stop at stop signs too, but who does that?
Exactly. But it is amazing. I mean, her phone rings a whole lot more than mine. I don't know why, but it's like 2:00 in the morning, that thing will ring. Oh, and so.
That's awful.
Yeah. So I was teasing her over the weekend, and so now she every time phone rings, she goes, "Oh, excuse me, my boyfriend's calling." So,
it's my other husband.
Yes. All right. So talking a little bit about the markets and you know kind of what's going on. You know, it's interesting because you know we've been talking about you know fixed income bonds. You know, for a while we've written numerous articles about it because there's so many questions. You know, we just don't spend any time in the financial media talking about bonds, right? We just kind of know they're out there, and they're very simple, and they are the most simplistic investment to make. Bonds are extremely easy, but because nobody talks about them, they seem like they're very complex, right? But they're not. you're just making a loan to somebody else and they're going to pay you back your principal and interest. That's it, right? And your interest rate is simply a function of what the market, demands for the most part. And, that interest rate is set by, various things: economic growth, inflation, opportunity cost. Those are the things that kind of set the interest rate. And it's always interesting because there's all these other narratives that come about whenever there is a move in one direction or the other about interest rates. And, the latest migration of these narratives is the government debt, right? Because we've gone to $33 trillion in debt in the U.S. And, this is obviously the reason why, interest rates are going to just keep going higher from here. The only problem with that narrative is that, we've had trillions of dollars in debt for the last 40 years. And we didn't have an interest rate problem previously. So why now? Why is it just this magic moment? We just crossed some magic hurdle rate and all of a sudden everybody goes, oh, well, it's the interest rate. It has nothing to do with the debt, right? It's economic growth, it's inflation, it's wages. That's what it is. So why are interest rates up? Interest rates are higher because if I want to make a loan to Brent, and I'm the government in this case, and Brent wants to borrow money from me, or I want to actually, technically, if I'm the government, Brent is the lender, right? I want to borrow money from Brent, and I'm the government. So Brent says, okay, I'll loan you money. I know you're good, right? I know you're going to pay me back. That's why treasuries are a risk-free investment. The government always pays its debt because we have a printing press. So Brent can mark off his list default risk, and because he knows he's going to get paid. So what other risk does Brent have to factor into his loan? Well, he's got to factor in inflation. Well, inflation's definitely higher than it was a couple years ago, so I'm going to have to charge more for that. Plus, I need to make a little bit of money above inflation, right? I can't charge 3% interest rates if inflation is 3%. I've got to charge something over that because I want to make some money. I mean, the whole reason that I'm loaning money to somebody is so I can make a return on my investment. So, but I also have to factor in wages. Because if I'm a business, I'm paying wages to people. Wages have gone up. With all these stimulus checks and shutting down the economy and everything else that we did, we created a lot of demand in the economy with fewer employees, and that drove wages higher. So I have wages that I have to compensate for. If I'm a business owner, right, I've got to compensate for that. And I've got to compensate for economic growth because economic growth is where opportunity comes from. So if I'm going to loan money if Brent is going to loan money to me at some rate, he also has to evaluate, well, I could take that money and invest it into the economy and make more money, right? Opportunity. So I have to evaluate those. So that rate that is being lent at has to compensate for those things. It had nothing to do with debt because I'm going to get paid back. I have no default risk. Debt, the amount of debt matters when it comes to corporate bonds. Because if a company is heavily indebted, their default risk is going up, right? We don't have that risk in the U.S. And if you want a good example of what I'm saying, just go look at Japan and the amount of debt that they carry. 260% of debt to GDP, right? We're at about 113. Their interest rates are near zero. So interest rates are always a function of economic growth, wages, and inflation. Ultimately, at the end of the day, there's about an 85% correlation between that index and interest rate. So yeah, it can vary, from time to time because of demand supply issues. One of the things that we've got going on now. But set aside those narratives that are not grounded in economic realities, and focus on what actually drives yields over time, and that's the fundamental factors. But it's always interesting because, if we take a look at, what's been going on. So for the last 3 years, bonds have had not just yet, Brent, you're a little bit ahead of me. But that's okay. You can leave it up. It's fine. I'll get there. It's just going to take me a little bit longer to get there. Over the last 3 years, bonds have had basically a 50% correction. On the magnitude of a correction that we saw with stocks during 2001 and 2, as well as in 2008. Stocks corrected by 50% both times. So here we go. We're in the middle of a real bear market for bonds. And this is the longest bear market on record going back to 1787 for bonds. And yet nobody wants to own bonds. Everybody wants to own stocks. So you have bonds. Now think about this for a moment. Nobody wants to own a guaranteed payment of an investment because it's down in price and the yield is higher. So you're making more money by holding it. So nobody wants to own that, but in turn, they want to buy overvalued stock investments, which are currently running at one of the highest valuations that we've had historically going back to the 1850s. Now, this isn't surprising because this is how investor psychology works. And, this year is a good example of that. Everybody's been chasing technology stocks this year, technology, communications, discretionary. So if we look at the top 10, top 7, 10, stocks, that's where all the returns this year for the market has been. This chart was as of Friday. So this chart didn't capture yesterday's move, but as of Friday, the market cap weighted index was up 11% for the year. The equal weighted index, which strips out the impact of the market capitalization of those top 10 stocks, was negative 1% for the year. So if you've owned other stocks in the market, you've had no return this year, right? Your return has come from 7 stocks primarily. But see, this is always psychology, right? We look at the S&P, we go, oh, the S&P is up, this much this year. So, man, and bonds are down. So I want to own stocks. I don't want to own bonds. But again, as we take a look at that, this is the primary reason why over the long term, and Dalbar does this great study every year they put out on investor psychology and why investors consistently underperform markets over the long term. Now, that doesn't mean you should beat the market every year. You're not, right? Nobody's going to beat the market every single year. And this is why the worst thing you can do is measure your portfolio from January the 1st to December 31st and measure your performance. It's the worst thing you can do psychologically to yourself because it's going to wind up making you chase last year's performers and you're always going to be on the wrong side of the trade. Look at it over a 3-year period, a 4-year period, a 5-year period. Have I done relative to my goals? Don't worry about the market. Market has nothing to do with you. What's your goal? I want 6% a year, 5% a year, whatever the number is. How have you done over a 5-year period? That's all that matters. Anything shorter than that, you're starting to just induce psychological impacts on your portfolio management. But again, we're trained by the markets to do this, right? It's like, oh, this is what the market did today and yesterday, and this is what the returns are since January the 1st. We're all geared to that, right? Because of the media. Worst thing you can do for managing your money. But this is why 50% of the reasons hurting, confirmation bias, loss aversion, and we go right down the list of all the psychological investor behaviors that lead to losses and underperformance in portfolios over time. The other 50% is you have your capital, you need it for something else, or you can't invest, or you don't have any capital to start with. But 50% of the reasons for underperformance of people that do have capital that invest, their losses and underperformance are almost entirely related to psychological factors. Now, what does this have to do with bonds being undervalued? We'll talk about that when we come back from the break and some of the important points about contrarian investing. Be right back. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
October means it's time for open enrollment into Medicare. How is your health insurance going to work after you leave your job? Our next Lunch and Learn will tackle transitioning to Medicare. Thursday, October 12th with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn. Thursday, October 12th with Ratliff and Rosso at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Bond math is confusing. It's like my wife's girl math. She's convinced that if she buys something at 50% off, she made $50.
The Real Investment Show podcast.
She's now coming up with things about guy math. Every time I buy a new gadget at the house, she's like, guy math. I'm like, hey, yeah, but I save money because I don't have to work as hard. My time is worth money, so I'm saving money if I buy something that reduces my workload at home.
At realinvestmentadvice.com.
Guy math.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, welcome back to the show this morning. Talking a little bit about investor psychology and why investors kind of always on the wrong side of the trade. You know, and again, timing is everything, as they say. And, you know, it's certainly understandable in the short term when things aren't working. You know, again, since we measure our performance from January the 1st to December 31st, if something's not working, it's like, oh, this is terrible. You know, this investment's not working and I'm not making money in it. And, you know, these things over here are making money. So I'm going to jump over there and do that. Well, you know, typically what happens is we kind of jump from the frying pan into the fire because what was working last year is not going to work in the coming year. Good examples of this, and we've talked about, you know, we've written articles on this. We've talked about on the show back in November of 21, oil prices had gone negative. And nobody wanted to own energy stocks because of, you know, ESG and climate change and all this other nonsense. And we said, look, you know, it's all about the money at the end of the day. And, you know, back in 1998, 1999, it was don't invest in sin stocks, right? We don't want to support those industries. So no gambling, no tobacco, alcohol, etc. those were the best performing stocks during the dot-com crash, right? Everybody wanted to be in dot-com stocks. Nobody wanted to be in fundamentally strong companies until where everybody was no longer the place to be. Same thing then, same thing in 2021. We said, hey, everybody hates energy. Probably a place to be going into 2022. Positive returns all year, up 40%. Rest of the market was down 20%. It's always about where the money goes. And as soon as money shifted and money started chasing energy stocks and people were making money in energy versus other stuff, guess what happened to the whole ESG theory, right? Went right out the window. It's like, Same thing happened to the sin stocks, by the way. Nobody the whole don't invest in sin stocks died a brutal, ugly death, just like ESG did. Has nothing to do with climate change or anything else. These were narratives put in place in order to generate returns. And, we talked about the fallacies of ESG numerous times. People were charging 4 times as much to give you an S&P index return. It made no sense. And that ultimately investors figured that out. But, chasing that, ESG mantra wound up costing you money. Same thing in November of 2022 in the midst of the bear market. Faang stocks are dead. Right? This year, can't get enough of them. In fact, that's all that people want are the Faang stocks. Nobody wants any of the other stocks. So it's always the narrative of when everybody hates something, right? That's probably the time that you want to start thinking about owning something. And, particularly when it comes to bonds that have a guarantee of repayment, there is a fundamental underpinning to those investments that stocks don't have. Stocks can go to zero. Bonds can't. Not government, not treasury bonds. Corporate bonds, yes. Other type of non-guaranteed corporate, community, municipal, whatever. Those bonds can go to zero if there's a default. Government bonds don't go to zero because they have a guarantee of repayment from the government. So, what drives interest rates on the long end, what drives interest rates on the short end, 2 different things. We've talked about this numerous times before. But, importantly, when we look at valuations, and we talked about stock valuations earlier, right now everybody wants to own equities, but they're super expensive. And bonds are very cheap relative to historical values and cheap relative to the economy and what's going on at the moment. And so you have this historic gap in valuations, but yet nobody wants to own the undervalued asset. Everybody wants to own the overvalued asset. And again, this is psychology. I'm chasing what was performing and I'm ignoring what isn't performing. And yet there's a fundamental valuation argument on bonds that is being grossly overlooked. And I know we've talked about this numerous times, but again, there's just this consistent narrative of misinformation that is out in the world. And the latest misinformation of this is that, we just have too much debt, so that means interest rates have to go higher. And that's not how it works. Because again, bonds are a function of interest rates, economic growth, and inflation. Now, if you could X out all of the psychological side of bonds would always theoretically match economic growth, wages, and inflation. So whatever that number is, that's what yields would be, right? It'd be an almost exact match all the time. If the stock market didn't have any human influence into it, it would be basically a set number most of the time because nobody would be buying or selling. This is the whole, the whole fallacy of, passive investing. Oh, we're just all going to buy stocks and we're going to buy this ETF and we're all just going to hold it. We're just going to be passive. Nobody's going to buy or sell anything. If that was the case, markets would just be flatline. They wouldn't go up or down. What makes markets go up or down and what makes bond prices go up or down is the psychological impact of people trading. And right now, you have in interest rates a detachment of bond prices versus the underlying valuation because of massive shorting. We talked about this last week. You have massive short positions, so people are selling bonds they don't even own, so it's creating selling pressure on bonds, driving prices lower, yields higher, outside of what they would be normally. Has nothing to do with the amount of debt. It's just that there is a trend of prices that these computerized trading algorithms and hedge funds and others are taking advantage of, and they're driving these yields up and prices down because they're making money with it. Now, the issue with that is that when it reverses, they're going to become net buyers rather than net sellers. So this whole thesis, again, is wrong that, oh, nobody wants our debt. We have just too much debt, so there's this dearth of buyers. No, there's plenty of buyers out there. Right now, they're just net sellers. But when they become net buyers, because prices are reversing, they're going to fuel that price reversal higher. But this is why bond prices move up and down over time. This is why yields go up or down over time. It's the impact of what's happening within the economy and the markets. So, this just goes back to the basic premise of, contrarian investing. And I just want to read to you a quote, and this is one of my favorite quotes about contrarian investing because this applies specifically to where we are right now. Resisting and thereby achieving success as a contrarian isn't easy. Things combine to make it difficult, right? So if you've been long bonds this year, as we have, right? We have a fundamental thesis about owning bonds and portfolios, but it's been a difficult year, no doubt, because as bond valuations kept getting cheaper and cheaper, we kept adding more and more to our bond portfolio, and we're going to continue to do that. But here's the important part of this quote. Things combine to make it difficult, including natural herding tendencies and the pain imposed by being out of step, particularly when momentum invariably makes pro-cyclical actions look correct for a while. Sound familiar? Given the uncertain nature of the future and thus the difficulty of being confident in your position is the right one, especially as price moves against you, it's challenging and lonely to be a contrarian, and that's absolutely the case, right? It seems like right now that, yields just won't stop going up and bond prices won't stop going down. You've had 3 years of a bear market in bonds and a 50% decline. And, it's interesting because if we go back to 2009, in February of 2009, I wrote an article called 8 Reasons for a Bull Market. Nobody at that moment believed we were about to have a bull market in stocks. Stocks were down 50%. The general attitude was the stocks were going to zero. There was no bottom for stocks. There was no upside for stocks. Nobody wanted to own stocks at all. And of course, March 9th, 2009 was the bottom for the next 13 years. But here we are. 3 years into a bear market, 50% decline in bond prices, and everybody believes what? There is no bottom for bond prices. They're never going up again. Psychology is a difficult factor to navigate within your portfolio, but that's where opportunity exists. Howard Marks also stated this: in good times, skepticism means recognizing the things that are too good to be true. Think about stocks. That's something everyone knows. But in bad times, it requires sensing when things are too bad to be true. People have a hard time doing that. The things that terrify other people will probably terrify you also, but to be successful as an investor, you have to be a stalwart. After all, most of the time, the world doesn't end. And if you invest when everyone else thinks it will, you're apt to get some bargains. Howard Marks. All right. Wraps up our conversation. Stock bond valuations. It's on the website now with all the attentive charts, quotes, etc. So if there's anything in there you liked, it's on the website right now, realinvestmentadvice.com. We'll be back. Wrap up the show this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
October means it's time for open enrollment into Medicare. How is your health insurance going to work after you leave your job? Our next Lunch and Learn will tackle transitioning to Medicare Thursday, October 12th with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn Thursday, October 12th with Ratliff and Rosso at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. So over the weekend, kind of a interesting tidbit. Independent parties have always had a very difficult run in presidential elections because it splits the vote. And we go back and look at when Ross Perot ran for president, and it split the vote on the Republicans. So, you only have so many people are going to vote Republican, so many people are going to vote Democrat. And if you throw an independent in there that leans in one direction or the other, it splits the vote for that primary candidate. So, again, back when Ross Perot ran, he took votes away from the primary Republican presidential candidate, which allowed Clinton to win the election. And so it's interesting now, and there's a reason I'm bringing this up, is that over the weekend, Robert Kennedy Jr. announced that he left the Democrat Party to join, to basically run a campaign for president as an independent. So we now have an independent party that's not entirely an unknown factor that will potentially pull votes from one candidate or the other. Depends on, kind of what the views are. But the reason I bring this up is that coming up in January, on January the 24th, we're still locking down the date, so it's going to be towards the end of January. We're going to have an economic summit here in Houston, and we're going to have Greg Villieri come in to speak, and he's a political, kind of a market political analyst, and to talk about the 2024 election, what that means for markets, all that type of stuff. And it'll be interesting to see what his views are on kind of this idea of a split ticket, but how this is all going to play out in terms of the markets itself, et cetera. So we're putting that together now. We'll start advertising for that and open up ticket registration here soon. So if you're interested in coming to that event, it'll be January the 24th. We're going to try to have my friend Adam Taggart come in to speak as well. So again, we'll have kind of a lot of things going on. And so it'll be, from 8 a.m. to noon, 1 o'clock, we'll feature breakfast and lunch, that type of thing. Have a panel, talk about this stuff, answer questions, but kind of get a view on what, is going to be kind of the impact to the markets as we get to next year, which is a presidential election year. So anyway, mark that down. We'll start advertising that here in the next couple of weeks and open up registration for that. Okay. Anyway, so, just talking a little bit, I know have been going over bonds a lot lately. And again, it's just because there's so much misinformation out there. And we've, again, just if you go to the website, realinvestmentadvice.com, I keep swearing every week that I'm not going to write any more articles on bonds, and then somebody says something stupid, so I have to write another article about that. But bonds are very basic. Again, I wish we had, a media channel like CNBC or something that would just at least have a small segment, a couple of times a day on, how bonds work, what are bonds, kind of a bond segment, what bonds are moving, what bonds aren't moving, that type of thing. But again, bonds are boring at the end of the day. You're not going to double your money in bonds. It's just not going to happen. You're not going to have an NVIDIA in bonds. But there's often great opportunity to make a lot of money in bonds if you know where to look. And there's some great opportunities that are coming up. One of those is mortgage-backed securities. And again, this is another one of those bonds that people don't understand. And when they own them, they hate them because they always show a negative return on your portfolio, right? It's your portfolio statement. They're always negative. And the reason is that when you buy a mortgage-backed security, you're buying somebody's mortgage. So Brent has, and normally what a mortgage-backed security is, it's a whole big pool of mortgages, right? So they take all these mortgages of a particular type and they bundle them up and they create a bond around it, and then they sell you the bond. So you own a whole pool of mortgages. But very simply, what a mortgage-backed security is, it's just simply somebody's mortgage. Brent has a mortgage on his house. So he goes and buys a house. He's got a 30-year mortgage on it. He's going to pay, 5% on his mortgage. Okay, I'm just throwing out numbers. So every year you're going to get what? Now, your first thing is I'm going to get a 5% interest payment. Yes, you are. But the payment you get is principal and interest. What does Brent pay every month? He pays principal and interest on his mortgage. It's a 30-year bond. So at maturity, the principal has to be what? 0. So when you own a mortgage-backed security, it's always negative because every month, what you paid for the bond, I paid $1,000 for the mortgage-backed security, right? And so the next month, I receive $2 in principal and $5 in interest, whatever the numbers are. So now the principal value of my bond is no longer $1,000, it's now $998. So when I look at my statement, I've got a $2 loss. Oh my gosh, I lost money. No, you didn't. It's in your cash account because you received $2 in a principal payment plus your interest. 10 years later, you still own the bond. It's still negative because you've been receiving principal payments for the last 10 years. So it's worth 70% of whatever it was originally. Plus you've been getting interest payments the whole time. Then Brent moves. Brent goes and buys a new house. What happens when he buys a new house? That mortgage is paid off. So your mortgage is so the mortgage bond gets all of its principal back. You get your final interest payment and you're done. The average holding time for a mortgage is about 7 years. It's longer right now because of where interest rates are. People aren't moving. But see, understanding where opportunities exist is very important. Right now, interest rates are very high on mortgages. So let's think about this for a minute, right? Why is there an opportunity in mortgage-backed securities? Because interest rates are near 7% on a 30-year bond. So Brent goes out and he says, I really got to buy a house. So he buys a house, he gets a 30-year mortgage. He's paying 7% on his mortgage. So every month he's making principal and interest payments with a 7% mortgage. He's like, man, it's just killing me at home. And then interest rates eventually come down, right? So interest rates go from 7 to 6 to 5 to 4.5. Pick a number. Brent, not being an entirely stupid individual, goes, wait a minute, I can refinance my mortgage at 4.5 and get a lower interest rate. Now, anybody with 2 brain cells is going to figure that trick out pretty quick, and they're going to refinance their mortgage. So he's been in his house for 3 years. You go buy a mortgage-backed security today at 7%. I'm not telling you to do this. This is not a recommendation. We're just talking about opportunity. Because, see, everybody assumes right now that interest rates can only go higher. They're going to come down, especially when you have a recession. And when that happens, people are going to refi their mortgages. And there's a whole pool of people out there waiting to refi their mortgages. In fact, having said that, this morning on Twitter was a statement. Thought this was interesting. The National Homeowners Association, not National Homeowners Association, sorry. The National Realtors Association. I am sure that they're going to form a national association of homeowners at some point, just so they can terrorize more and more people. But they sent a letter to the Federal Reserve saying that interest rates, the restrictive level of interest rates is increasing housing unaffordability. And they are asking the Fed to start bringing rates back down to make homes more affordable for individuals. Why? Because they want to sell more houses. The Mortgage Association wants to sell more mortgages. Can't do that at 7%. Nobody wants to finance anything at 7%. And so that whole business has died. So they're now requesting the Federal Reserve to please start cutting rates. Please stop hiking rates because we need rates to come lower so we can have some business, please. And that'll eventually happen. But if I have a mortgage-backed security at 7%, I'm getting 7% interest, and as soon as Brent refis that mortgage, I get all my money back, plus my last interest payment. So mortgage-backed securities are undervalued relative to where we're going to be. So and this is my point, there's a lot of opportunity out there. But you have to understand the real value and there's a lot of things to get into. You can get into convexity and a whole variety of other things. But at the end of the day, bonds are undervalued relative and very much so relative to bonds, but also relative to where we are economically. The market just cannot sustain higher interest rates for very long. You're going to have some type of financial event, recession, or crisis at some point. It is just a function of time, and we are likely closer to that point than not. So the point of the whole article today, and again, just looking at where the world is, if you are absolutely appalled by what's going on in the bond market, maybe it's the time to start looking at buying something. Baron the Rothschild said, you buy when there's blood in the streets. Nobody wants to buy anything when everybody hates it. That's the hardest part about being a portfolio manager. It's the hardest part about doing anything is buying stuff that nobody wants because you've got to suffer through it. But that's where money is eventually made. Anyway, wraps up the show for the day. Have a great day. Be back here tomorrow with Danny Ratliff, and we'll talk about what's going on in the markets after today. We'll see if this market can rally a bit today. We'll see. Market futures are kind of flat right now as we kind of open up today again. Still, concerns over what's happening overseas, but we'll see how this market fares today. Again, got resistance to deal with this morning right at the 20-day moving average. So get a little bit of a sell-off today. We'll see what happens, but we'll bring you back up to date tomorrow right here on the next edition of the Real Investment Show. Have a great day.